to invest, you have to set standards of quality that you do not let them waver. You don't make exceptions. Your buddy says that this Bitcoin is better than any other. That's not good enough. That's not good enough. Okay?
Quality of your thoughts and actions. Welcome to the Legacy Podcast with Ernest Wood, where we explore the path to true happiness, enduring legacy, and becoming the man you're meant to be.
Hey, everybody. I'd like to welcome you to the Legacy Podcast with Ernest Wood. Our special guest today is Steve Sellingut. He is a fantastic man, a best-selling author. And I'm going to have to retake that because I hit the wrong little button. So I'll cut that out. Let me start over, buddy. I was trying to find you and I lost you again. Gosh dang it. Sorry about that, Steve.
It's okay.
Like I said, I'm a rookie, man. All right. So here we go again. Hey, welcome to the Legacy Podcast with Ernest Wood, where we explore different men's stories and we hear from them at different seasons in their life, their definition of legacy, happiness, and they're going to share some of their struggles, some of their insights, three keys at the end of the show to further success for all of us. Today, I have a fantastic guest, Steve Sellingut. He's a best-selling author, retirement independency coach. He teaches people, you know what? I'm going to let him tell you because it'll sound much better coming from the professional. Steve, go ahead and tell us how you do this and what do you do?
Thanks, Ernie. Well, you just about had it. I'm a retirement income independence coach, and I got there uh, by a long road that started back in '79 when I started a business as a professional investment manager, where I was, it wasn't like working for a big company like Merrill Lynch or something like that and being a broker. This was my own business that I had to do my transactions through a brokerage firm, but I was hands-on managing portfolios for what became well over 100 different families throughout the country. I did it in a different manner. I focused on income instead of the chasing of market value. I tried to get people to a point where, as my current title says, income independence, where they knew that they had enough income provided by their investments to do pretty much what they want to do with their life, particularly in retirement. Of course, I started doing income investing myself when I was only 25 years old. So income investing is not just for the old people. It's for people who want to transition from a young, successful career of any kind so that they have this secondary source of income other than their salary that gives them as well the independence to say, hey, I don't want to work in New York anymore. I want to have my own business like I did and say, goodbye, employer. I'm making more money on my own than you're paying me. I'm going to go get started. So that's what I'm all about, is getting people to that point where they have the independence to take care of themselves in retirement. And on the way to retirement, they have the income independence necessary to change jobs, to start a career, change careers, and do things like that.
That is awesome. We were chatting a couple of days ago, and you were saying something about everybody chases like the capitalize or the big number that's on the screen, right?
Right.
But you focus on what you're actually able to live on. How do you set that up different, and what is the difference in that?
Well, the difference is in the type of securities you buy and put into your portfolio. Um, there's There's two basic kinds of securities that we trade, that the world trades in its various stock markets. The first one are called equities. They're stocks, and what they represent is ownership of companies. Like if you own 100 shares of Exxon, you're an owner of that company. You have the same risks as any other owner. Um, the smaller the company, the less well-heeled they are, the more risky the company is, that ownership entity. Um, the other, t- uh, so companies raise capital to run their operations by selling shares. They also raise money from the banking industry. In fact, the amount of borrowing probably exceeds the amount of equity investment. But they sell bonds, and in a sense, when you buy a bond or a security that contains bonds, you're loaning that corporation money to run its operations. So there are two forms of securities. And when you're an investor, you usually look to the equity side as something that you're owning to produce growth in market value. You're looking for the income type investments to give you interest or dividends, um, that you can use any way you want to. You can reinvest or you can pay bills with them, whatever. So those are the two types of securities. You can take these securities and own them in a form of investment that's called closed-end funds, which are trusts that hold these securities, and managers run the portfolios, and they're dedicated to generating income. So you can either buy just income securities individually, or buy stocks that pay dividends, or you can buy things like closed-end funds that pay large sums of money in excess of what the securities themselves pay. And it's much safer when you have a broadly diversified portfolio of stocks or bonds than buying individual stocks and bonds. I don't know if I went too far there, but
Oh, no, I was just trying to follow along. So basically, you're saying like what pays the bills is the realized income, not the market value.
yes, that's where once you get to that point where you know what you're doing, you're exactly right. Then if you want to generate income, you focus on the income being produced by the securities, and you transact within that group that pays the best, safest amounts of income. Absolutely.
So there's
The
some great financial risk minimizers, and I think a lot of us probably don't know what these are. And I know I'm one of these guys who like take way too many risks, and I've
well,
lost way too much money investing. What I call, well, I don't even know if I should call some of my crap that I've done investing. But what are these? What are some of these things that you could help and
I
tell people
guess
about?
when you start buying buying pieces of companies or loaning money to companies, which basically we're doing when we buy these securities, there are two types of risk to consider. Um, Wall Street talks about the prices going up and down. That's what they call market risk. The risk that the prices will vary, and they may go down. They may go down for a long period of time, but that's really not a risk of loss so much. It's only a risk of loss if you panic and you sell the security. Okay. It's really the natural order of things. Prices change with demand for the security. So every security has market risk no matter what. Okay. Prices are going to go up and down. The real risk you have to contend with is financial risk. Now, that's the risk that you're going to buy something, a security of a company that could go out of business and go bankrupt. Like one of the AI stocks just declared bankruptcy today or yesterday, and it's going to zero, folks. All the
Oh man.
stockholders, all the stockholders lose everything. Some of the bondholders may get a few pennies on the dollar, but that's financial risk. And in order, and that's the risk you want to focus on. That's the risk that actually takes money from you. You don't have to, you don't have a chance to sell it for a profit. It's gone. Period. You lose everything. And the way, and the four risk minimizers that you were alluding to avoid that kind of risk, are these four things. The quality of the security. For example, if you were to take a ride in a car in a metropolitan area, you would go buy signs from probably 50 different companies that you know the names of those companies. You know the Walmarts, you know the various oil companies, you know the healthcare companies that are advertising on the billboards and stuff like that. These are companies that have been around a long time. They pay dividends. They've got proven track records. They employ thousands of people. They're big time operations. They are safe and secure investments when you buy their stocks. They're profitable. They have diversified product mixes. They pay dividends. They've been around a long time. That's you develop a way of saying, okay, I'm looking at this particular security. How good a company is it? What's its quality? Well, if it's a new issue, it's just come out, it's never paid a dividend. It's not profitable. It's just getting started, right? So two out of the four things we just talked about, it doesn't have. So that makes it much, much riskier. So in starting to invest, you have to set standards of quality that you do not let them waver. You don't make exceptions. Your buddy says that this big coin is better than any other. That's not good enough. That's not good enough. Okay. So anyway,
So
so
you're
that's the
telling me
main.
that's not a good thing to do is ask your buddy which one.
No, you don't want you want to make your own decisions as to what you invest in, and you have to have your own rules and parameters. What I set as quality standards might be much more restrictive than somebody else does. Okay. So you have to set your own rules. You have to determine how much risk you really want to have. And that will depend on how strict your quality standards are. The next thing you want to do is when you start buying securities, you want to make sure you're well diversified. And you're diversified in many ways. You're diversified by the sector the security belongs to, healthcare, energy, da da da. You want to be diversified in the sense of how much money you have in each particular stock or entity you buy. You know, what percentage of that is the portfolio? You want to keep it way below 5%. Um, I believe in complete. I own hundreds of securities, so I keep my percentage in each one below 2%. So if we have a financial crisis and Merrill Lynch and Lehman Brothers go out of business, I'm not going to be hemorrhaging because I own a lot of either of them. You know, when my wife, when we had the Enron scandal, I don't know if you remember that way back, it went to zero. It was an A plus rated company at one time. My wife had it in her IRA, but she only had a couple hundred shares. So she didn't even notice the change in her portfolio when it went under. So, and that one passed all the quality tests that I could make up. It was just one of those frauds, that happens. But diversification keeps you out of trouble by spreading your risk, spreading your already limited risk amongst a lot of different securities. And that's why I use closed-end funds because they themselves own many securities. So if let's say you're just starting out and you're young and you want to go in the stock market, you can buy a closed-end fund that owns 250 different stocks. That's a whole lot safer than putting your money into one stock and hoping it's a good pick. You know what I mean? So diversification is important. So I
What?
set up, go ahead.
Oh, go
I'm
ahead.
sorry. I
Go
set
ahead.
up I set up diversified portfolios that are comprised of hundreds of diversified portfolios. That's the second one.
So you have a portfolio that's so you have a whole lot of stuff in the portfolio, and then there's a whole lot more stuff. So you have a whole lot of those built on top of each
Right.
other. So yeah, because I'll just give you a quick story of what happened in my life. I had a awesome 401k. I just started at a power plant, and I guess I'll give you the name because whatever. It was NRG. They were Reliant Energy. They changed the RRI, and then they went to NRG. And this was around the same time as the Enron thing. I found a shortcut in their 401k system where I could round robin their stock because we were allowed to have own the individual stock and then go to the mutual funds. But you weren't supposed to round robin, but I found like a little shortcut because their stock was going from say $18 to $28 and it was just doing this cyclic thing and it did it like every quarter. Boop, 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 boop. So in less than a year and a half, I went from having like 10,000, I got it up to about $220,000.
Oh boy.
And I was just killing it, right? But one day we're in a meeting and then all of a sudden this is when we found out all those ass clowns were fudging the books a little bit. So that stock price went from $28, it was right near its peak, and it went all the way down to $5 or $6. And so my portfolio or my capital or whatever it is, the market value went from 220, 230 all the way down to like 31,000 or something.
Oh boy.
And at the same time, they decided because of some regulations that we weren't allowed to hold a single stock in our funds anymore.
Hmm.
So I had to sell. They weren't going to allow me to hold it and allow it to rebound. So I locked in the full on, 90% loss basically. And the CEO of NRG came out and he explained to us why, and I asked him a couple questions, and then he told me, he goes, well, just think of it as a house. Like if you buy your house at the top of the market and you sell it, then you lose money. So I told the CEO of NRG that the only difference there is some dumbass isn't making me sell my house at the bottom. That would be my decision. Unlike right now, where a dumbass is trying making me sell.
Right.
So I know what you're saying about widening, keeping a larger than having everything in one little stock.
Exactly.
It can
So
definitely cost you a lot of freaking money.
yeah, diversification is certainly a way to reduce your financial risk. So that's the two of them. Did you have
And
another?
then, oh, go ahead. I'm sorry. I thought you were done. My
No,
apologies.
we've only covered two.
Man, I suck. I jumped in on the middle of it. Let's go
That,
back. All right. You
no
got
problem.
two.
No
Let's
problem.
get
No,
them.
I'm not that old that I lose my train of thought that easily. Okay, we're on number three.
All right.
Number
Number three.
three is everything you buy, and it's really part of the quality, but everything you buy should be generating income for you. And that's a simple rule. You only buy stocks that pay dividends. You only buy ETFs and closed-end funds that pay distributions, and that's it. Everything has to pay income. Something has to be coming to you. And then the fourth one, which is the one that would have helped you in your situation, as well as diversification, is profit taking. Is profit taking. You have to have known targets. You have to say, I am going to take profits on on any stocks I own, 10%, I'm out of there. I'm going to somehow take that profit. I might just sell a portion of it and then invest that portion in something else to appreciate the profit, or I might sell the whole thing and reinvest the whole amount instead of one position. Maybe now I'll have three positions, things like that. So profit taking becomes the final risk minimizer. So if you had that rule yourself every time it went up 10%, you had taken your profit and put it into one of the other offerings, it wouldn't have mattered when it went down like that. So it was both the diversification and the profit taking that would have helped you. But those are the four great risk minimizers. And if you always adhere to the QDI, quality diversification income, and you always take your profits, your your chance of getting crushed by a company that does something like happened to you, or the Enron or the Merrill Lynch type thing, the chances of you getting burned seriously are, minimized significantly.
It's and I think it's part of our world today, right? We found that everybody looking for instant gratification, but with investment, it's not instant gratification, right? It's a long term. Even with Warren Buffett, like his average rate of return is not the highest in the world, but he's consistently done it over and over and over. And since the time he's hit six, I think he hit 60 and now he's almost 70 something, and his wealth has grown to billions of dollars because it's the power of compound interest, right?
Exactly. He's always is in high quality things. He's not a he buys companies where we buy stocks of companies.
Yeah.
But he's always been a quality and value. He's always been a value investor, is what he calls himself. And even and I remember it very distinctly back in the dot-com bubble, back at the turn of the century, when all the basically the Nasdaq just crashed because it was at such a high level, and all the tech stocks, they used to call it the media used to call it the no value rally. It was a rally in companies, none of which had ever turned a profit, but they were the most popular stocks out there. And a guy like Buffett wouldn't be having a big interest in those things because he's a value guy. And so he and I share that one bit in common. Um, when I was in the individual stocks, I never bought a Nasdaq company because predominantly they didn't pay dividends, and
Yeah.
everything's got to pay a dividend for me. The Dow Jones Industrial Average, for most of its existence, didn't have any. They used to call that the over-the-counter market, the Nasdaq. Didn't have any Nasdaq companies in the Dow Jones average until I think Microsoft might have been the first one to get in there. I'm not sure, but it was a lot of years ago, but it was hundreds of years or 100 years at least that there weren't any.
So what is the oldest income producing investment?
Ah, now that one, interestingly enough, is closed-end funds. Closed-end funds are it's a trust vehicle. It's a where a company establishes a trust, a pass-through trust, and it has a manager, and the manager manages a portfolio of securities that are inside this trust. And one of the things that the manager has to do in order that the trust doesn't owe any taxes at the end of the year, it has to pass all its profits through to the shareholders who have bought the stock that represents that trust. So that's what a closed-end fund is. It's a stock that shows that you own a piece of a trust. And then inside that trust are hundreds of different stocks or bonds or mortgages or things of that nature. And these closed-end funds, like I said, they've been around since the early 1800s, before mutual funds were established. Um, they use that, and they operate like we would when there are low interest rates. Like when there are low interest rates, I don't know if you did, but I did. I took out a loan, a HELOC, a homeowner's equity loan for, you know, maybe 100 grand, because I knew I could invest it in closed-end funds and get about 7 or 8%, and the HELOC was only at about 1 or 2%. It was down there at the bottom of the cycle, and as long as you paid it off. So that's the type of thing they do. They don't. They take short-term loans. These managers do, and then they. So what you bought when you bought the closed-end fund when they had the initial public offering and they raised all that money, they went out and they bought securities with it. So now they're taking a loan out, maybe 25% or something like that, and they're adding more securities to it. So you're getting income from more securities than you actually bought. So you're getting the benefit of this, just like every company in the world borrows money to build. Every McDonald's that's built isn't built with cash. It's built with a loan. They use leverage. They use borrowing power. So these trusts use that capability that is not used by either ETFs or mutual funds to do that. So that's one of the reasons why they generate so much income. Also, they trade securities like we would.
So right now, with the interest rates being so high, is it still like, like it wouldn't make much sense for me to pull out money out of a house right now at
Oh
7%.
no, no, no,
Yeah,
no. It's only that thing. And you're talking about interest rates high. Interest rates are actually today
relatively speaking.
they are high compared to where they've been over the last 20 some years, since 2007 or so. Before the Great Recession, the lowest interest rates ever got was to 5%. When I was buying my first house, it was more like 6% and stuff like that, or higher. I remember in the 80s when interest rates got into double digits, where
I
you could
think my
buy,
parents, I think my parents' first house was like 16% or something.
it may have been, if it was at
But
that time, yeah.
yeah, it's crazy because the house, I was probably like 30 or $40,000 though. So it was like when people buy a car with crappy credit right now, right? They're 30 or $40,000 car with 15% interest rate.
I know, it's crazy. And what I found, uh, just having done that, we bought a new car last year. I found that um, the way they calculate anymore, if they tell you got a low rate like 7%, and when you pay extra to pay down the amount you owe, they still charge you as if it was the same principal. They don't take that away from the principal like a mortgage would. You pay a couple extra bucks on your mortgage. The
Yeah.
next time you're paying a little less interest because you paid some principal. And if you pay extra, the amount of that's applied to interest goes down, and the one amount applied to principal goes up. These type of car loans don't operate that way. They were
What
still.
state are you in?
This was in South Carolina, but
Because
that's.
I was a finance manager at a car dealership, and in California, I don't think they're allowed to do that because you
I
can.
wouldn't. It.
It's weird because that you said it, and I'm not gonna, but I think that if you specify that it has to, like the extra payment goes towards the principal, that they have to take it off the.
Oh, they did, but they still were charging me the same amount of interest. This is what I asked them. I could talk to them. It was crazy. So I just paid the damn thing off. I didn't mess with them anymore. I just said I'm not going to do that.
Yeah, that doesn't even seem right because if that
No,
money's if
it doesn't seem
that,
legal.
yeah, that's what I was saying. I don't know. Maybe we'll have to check in. I'm gonna have to check in on that. So going back to those closed-end funds. What is like an average rate of return or the average yield now that you're getting on those?
Okay. On the equity side, the average yield right now is just under 9%. Uh, or I mean, just under 10%. Excuse me. It's 9.8%. That's this month's totals. And then on the income side, the ones that are in bonds and things like that, the total is 10.4%.
Okay, so
So so
you're
they're
right
pretty.
around that 10%. So you're doubling your money about every 7.2 years, right?
That's right. And that's without any profit taking. And of course these are all, it's amazing, particularly in the income area, because I when you buy bonds from a broker and stuff like that, it's not a simple task. and there's a markup involved, and they're either buying them at a premium or discount, but you have to pay accrued interest if you buy them from whoever owned it. And there's a markup. There's even though the commissions are gone, there's still a markup on bonds. So when you buy a bond, you're paying a markup, and the broker's making 1.5, 2%, or at least the brokerage firm, not necessarily your broker, but the firm is making like 2% every time in and out when you sell one and when you buy one. And it takes a lot of time. Whereas now with closed-end funds, you can get a diversified portfolio of literally hundreds of bonds. And you like pushing a button. You know, you push a button at Fidelity and say, buy this or sell that. That's how you do it. You could buy it just like that without any of the other aggravation because the trust takes care of all that aggravation. You don't have to deal with it.
So with the interest rates, like well, they went a little higher than normal, and then they're coming back down, and they're kind of settling in there. Is what is like the good spot for an investor? Or is there a sweet spot, or is it good to have them high, good to have them low? Because sometimes you hear different little things.
Well, it's really both ways is good for the investor because when interest rates go up, prices go down. But prices going down don't change the amount the bonds pay. You know, if you own a 6% bond and the interest rates go up and the price goes down, you're still going to get the same interest. The same dollars are going to come to you, even though the price of your bond has gone down. So, so it becomes an opportunity when they go up to buy old bonds at a discount or to buy closed-end funds. Is the best way to do it. You buy closed-end funds, their prices are a little lower and their yields are a little higher when as interest rates go up. On the other hand, when interest rates go down, the prices of bonds go up, right? So the price of your closed-end fund goes up, and then you can sell it at a profit. So it's a win-win situation once you own the securities. So the main thing to look at when you're buying income securities is the yield. So right now we just talked about it. We got about an average yield on all of these closed-end funds of 10%. So you almost don't care what the price is today because you're getting 10%, you know. And even if interest rates go higher and your price goes down, you're still getting that same income. Still getting that same income. So that's why I always say, it doesn't want, that's what income independence is all about. You've got this portfolio and you know it's going to be sending out this 8 or 9 or 10%, depending when you got into this game. And it's going to keep paying that regardless of what happens to interest rates or the stock market after that. So that's income
So,
independence.
that's interesting that you're kind of a win on both sides. So obviously it's better, since we have hopefully a bunch of men listening. Better the earlier you start, the better, right? It's just
Oh yeah,
it's the power of compound interest. It's all like that one thing of take a penny the first day and then double it for 31 days, or take ten thousand
right,
dollars a day,
exactly.
which
Sure. I mean, like you said, at 10%, $1,000 is $2,000 in about 7.5 years. And let's say you have a whole portfolio that's at 10%, as you can actually do today, and interest rates go down a little bit. Well, you're going to have some things that are going to go up, and you can take profits on them. So you can add more you can add more securities that way, and they're going to be yielding, a little less maybe, but still, they're still going to be adding to the pot where you're getting the income. You're going to grow your income every year. As long as you don't spend more than 70%, or let me put it this way, the less of this income you spend when you're younger, the more rapidly that compounding is going to take place. You may wind up doubling your income in a good year in 5 years instead of 7 years. That's
so
if you
with tax, like, so tax implication, do you like, are all these like, do you protect it in some kind of tax thing, like 401ks or Roth
Well,
IRAs, or
you're not
set it in a trust? Like, how is that all set up?
okay unless you're in a private 401k. Nobody's going to be offering you closed-end funds.
I just
Okay.
want to see, I wanted to ask that because
Okay.
I didn't think you could get in there.
You
So I was
can't, and
wondering.
the reason is because of the Department of Justice, the DOJ's rules about the amount. That's why Vanguard and some of the other mutual fund companies have come up with these 0.5% charges, because that's the only thing you can't, anything over 2% can't be in a 401k. So that's why they have this market that's just for them, basically. But generally speaking, if you have it in IRAs, it's going to be taxed, but not until you pay the RMDs when you're an old person. And in Roths, it's going to be tax free forever. So Roth IRAs are the ideal place to put the high yielding equity and income CEFs, because they're going to be multiplying at, say, let's say 9 to 10%, growing and growing. And when you need them, when you get older, and that's where your source of income is, you're going to have a huge cash flow out of those Roth IRAs that's not taxable. Okay, so there are also, so you don't, you've got them, they're good any place. You're going to pay taxes in a in a taxable account for sure. And you're going to pay taxes on profit taking in a taxable account for sure. In a tax deferred account, you're not going to pay taxes until you take your RMD out. And in a Roth account, you're never going to pay taxes.
Well, you
If
pay your tax. You already paid your taxes because the
you've
money you put,
already you've
yeah.
already paid it, but once you put that money in the Roth, if you make it as a contribution and you buy these closed-end funds, you're never going to pay any taxes. Period. So um, then also tax exempt closed-end funds, which only contain municipal bonds, and they come in a lot of different states like California, Wisconsin, New Jersey, New York, and so on. And you can use them. They're federally tax free and they're state tax free in your state. And in your regular account, and right now they're paying an average of 6.5%, which is unusually high. It's very high. And, so those are another, a good thing to use, because they're diversified portfolios of bonds and there's no markups to worry about and there's no accrued interest, and you can buy and sell, just push button, just like any other security.
So you're getting 60%, and then you're also getting the tax break of no short-term, long-term capital gains or
No,
anything
no,
like
no,
that.
no,
Or,
no.
oh,
If your
okay.
tax capital gains are always taxable
I,
in a taxable account.
oh,
You
okay.
you can't escape that.
So what, so what were you saying with the bonds? Like what, because you're only paid a percentage, right? You're paid a yield. Is that how those, like the municipal bonds that you were just talking about that
Yeah,
you said were tax exempt?
they're tax free, and they'll pay 6.5% a year. They'll pay a little bit monthly. It'll be, like half a percent. If it's 6%, it's going to be half a percent monthly that you're going to get almost every one. I think every one of them pays monthly. Um, and they're generally pretty stable, but they do. But since they're, when I say a single sector, they're only municipal bonds, as opposed to the other portfolios of taxable bonds that could be many different types of income securities. Since they're a single sector, they're much more prone to change with interest rate expectations. So
And
it makes them so it makes them really good when people are talking about interest rates going down, because they go up in price pretty quickly, and you can take some good profits there. So
so how should an income-focused investor gauge their portfolio performance?
I look at one, two. I look at three main numbers. Okay. Uh, I look at working capital. Working capital means the amount that you've invested in whatever these securities are. That's the amount you've put in there. And when you add money to your portfolio, that increases. When income comes in and you leave it there, that increases the capital. If you deposit money, I think I said that. And if you either take money out or lose money on a transaction, if you lose money like an Enron or something like that, that reduces the capital. So I'm looking because I know I'm getting all this income coming in and I'm taking profits. So I'm looking for my working capital number to grow every quarter. Typically it grows every month, but if it grows every quarter, that's what I'm after. And every year, that means I haven't spent more than I've made, or I haven't lost more than I've gained. So I'm looking at that one. The next one I'm looking at is the one I call the base income, and that's the income that this working capital produces because it's invested in all these closed-end funds that are generating income. So just the income that comes in, I'm looking at that, and I will look into that to grow every quarter. Okay. So then the third thing I'm looking at, the third major one, there's one other thing I'll look at, but the third major one is with Fidelity and most brokerage firms, and it's about the third or fourth page of your statement. It gives you this chart and it shows you your projected income for the upcoming 12 months. And I want to see that growing every quarter. So those are the only things I look at. Because if those three things are growing, my market value is going to go up eventually. And they're going to grow whether the market's going down, up or down, as long as I keep selectively reinvesting the income that I'm getting and I don't spend too much of it, that's going to happen. The one other thing I look at is the capital gains. How much money have I added to capital by taking my profits? That's a significant number. And what I'm trying to do, I really want to try to make my target is I want to make, I know, let's say how much that projection is showing you how much you're going to make in a year. So you divide by 12, that's how much you're going to make a month, right? So if I'm going to be making 30,000 a month, let's say, I want to make 6 months worth of profits every year if I can. That would be a good year if I could make that much in addition by taking profits. So far this year I haven't made 1 month yet.
It's still young in the year.
I know it's early, but I've made almost 1 month, not quite. So
So to kind of come around with that, so the markets go in cycles, and we're supposedly in a huge business cycle right now, right? From everything that I've read, they're supposedly going to be pumping in some funds here, some global liquidity should be coming into the markets. FDA or what is it? The spin down of some monies in the. How does that affect? I guess it would be like market cycles, right? How does that infect or effect how your investment management or strategies go?
well, the strategies, knowing where you are in the market cycle, and you only can know where you are. You can know where you are and you know where you've been, but you don't know where you're going. You don't know what's going to happen 5 minutes from now. So what you have to do is say, okay, I know the S&P may close at another all-time high today, but the others have not. But in general, the stock market is very near the highest level it's ever been in the history of the world, you know? So I know I should be taking profits on my equities, and I know that if when I buy any new equities, I don't want to buy as much as I normally would when they're not at an all-time high. You see, you you don't want to you don't want to time the market or think you know what's happening. And I keep 35% of my portfolio in equities. So when I have money I want to invest in the stock market, that amount of money. So I say, okay, I normally would go in, let's say I would go in and I would $6,000, I'd buy a new position. But I know the stock prices are the highest in history and they're more likely to go down than go up. So I'll say, okay, I'm only going to buy a new position for $4,000 because of this. So two things are going to happen. It's going to keep going up. What am I going to do? I'm going to take profit. If it goes down and it goes down enough, I'll add to my position. So that's how you use the market cycle. That's you alter your strategy. When the market goes way down, like it did in 2020, you say, okay, the stock market's way down. I can buy my full six. I start with six because if it does go down and I'm going to add to it several times, I don't want to get to the point where I have more than 2% of my portfolio in any one thing. The outer limit is 5%, but I never even get close to that. 2% is my target. So I'll start off small and then I'll add and add and add. And typically the market will go back up again and I'll be able to sell some of those additions so that when it goes down again, I'll be able to do it all over again. So back and forth. So that's what you do. So and on the other hand, on the income side, the income security prices are really way down, still way down from where they were 5 years ago. And I use a 5 year chart. I don't use 52 weeks like I used to with stocks. I use 5 years because these things are more sensitive to interest rates than they are to anything else, particularly on the income side. If you look at those charts to those individual securities, you'll see that they're way down from where they were 5 years ago. They're higher than they were a year ago when interest rates were going up, but they're lower than what they were 5 years ago. So they're still, I can take my full position on those when I start a new position. So that's how you use the market cycle. You know where you are, you think about what's going on. I say, okay, it's more likely in the current administration that they're going to force interest rates down even in the face of inflation. The Fed's going to say, no, 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 we can't. They're going to say you will, or I'm going to can your ass. Excuse me. That so that's the type of environment it is.
So, kind of going along with that, and then with the interest rates coming down, because I hear a lot of stuff that, like right now, with Trump pushing in the tariffs, it like strengthens the U.S. dollar, but overall, well, but overall, from what I understand, Trump, because of the last time that he was in, he prefers a little weaker dollar because it stimulates the overall global economy, right? With the US, you don't want, like, in some ways we want a strong US dollar, and in some ways we want a weaker US dollar because
I
everybody
know.
depends on us, right?
Yeah, but I've never understood currency and things like that
Oh,
so
okay.
much, and I never really concerned myself about it. But I don't really think that he cares a whole lot about the rest of the world and what they think from what he says.
Eh,
You know,
he probably doesn't think that much, but he also knows that we are I use this as a kind of almost a bad term. We're like the pigs of the universe. We are the consumers. I mean,
we
what's our
are
population? We're less than like 10% of the world's population. We consume 50 or 60% of the world's goods.
something like that. Yeah, yeah,
Yeah, so everything's based.
we are a big market. We are a big market, and I don't know. My economics. I'm not an economist, but I have taken several economics courses in my schooling and so on. And the tariffs, uh, if there were no tariffs at all, that would be the ideal situation for prices to be lower, for consumers, for everyone to benefit the most. I think this is more a management type tactic, a threat. So to get some sort of concessions about something else. So I think it's a scary game, and I'm sorry that we're being put through it. I mean,
In some ways though, because we've been paying, I mean, we pay tariffs all the freaking time. All our exports are tariffed to almost every freaking country. And we've been kind of taking in the shorts on a lot of it. And that's where like I think a lot of our businesses went off to other places because well it's cheaper labor, it's cheaper stuff, and then if there's no tariffs. But anyway, we'll go back to investing and
Yeah,
getting
because I'm certainly no expert in that area. I
yeah, we don't want to jump down a rabbit hole and start beating each other up on the no,
no,
I'm just
no, we don't
kidding.
want to do that either. So
Uh, so do you like dollar cost averaging? Is that something that you do like with the business cycle or you know like the market cycle? Or do you just have like you said you started 6,000 and you either put that in or just a little less? Like what would you
I
suggest for like a young
I
buck trying to
I selectively invest. I get all the income that comes in at the end of the month, or the beginning of the month, wherever, and how much I've taken all the money I have, and then I pick out what I want to add to. Dollar cost averaging means you take that sum of money and you apply it equally to every product, every position you have in. Drip investing is similar. That's where you automatically reinvest the dividends that they provide and buy more of the same stock. Uh, neither I don't have any love at all for either of those methods because I like to use that money to buy things that I think I want to add to my portfolio, and I want to add to positions that are down. I don't want to add to a position at a higher price than its average cost because that means I'm reducing my yield and raising my cost, which means I'm not going to be able to take a profit as soon. And my yield, my overall yield of my portfolio will be going down instead of up. So I use selective reinvestment to buy those securities that are down and to add new positions to my portfolios.
I, it totally makes sense. And like,
It,
I
it
guess I'm
require it
asking because
requires work.
that's what I
That's
was going to ask
it
is
does require work,
because a
yes.
lot of us, me included, I mean, I'm a little smarter than I was, but not a whole lot. But for many, many, many years, I just, you know, I did the dollar cost averaging on so many investments and because I didn't have time to actually, well, I probably did, but in my brain, I didn't have time to actually go and do the full, hey, what should I go here? What should I go there? It was a lot easier. And in my brain, at least it was getting something into the market, right?
That's true.
But is that a good way of looking at it? Because if you're consistently getting into the market and you're sending it to some crappy stuff, I guess that's when you have to have your a good manager, right?
Well, yeah, or you have to have those rules that we talked about, that quality diversification and so on. And the thing is, if you dollar cost average or if you drip, those are two different things. The automatic reinvesting, they all don't pay the same amount of dividends. So you're going to be adding and you're going to constantly adding to the same ones. And the one that pay the most, you're going to develop a bigger percentage of the portfolio in that one. And that's not a good thing. And you like I said, it just it raises it can raise the cost and decrease the yield. And I just want to have that money in my hands and make the decisions of where I want to put it to work harder. Because I can instead of buying $75 more of this because that's the amount of dividend, I'll buy $2,000 more of it if I take the whole dividends and put it in it because its price is down. I don't need to add to the ones that the prices are up. You see? So if you have to do your own selective investing once a month to invest the new cash coming into the account, that's okay. You can handle that amount of work. You know,
Do you how do you rebalance your because you say you don't like to have more than 2%. So how often do you rebalance?
well, rebalancing generally refers to asset allocation. When they're saying you got too much in the stock, the value of your stock market holdings are too high, So you want to put more in the lower ones. And I do it on the basis of capital. I don't do it on the basis of market value. But I never have to rebalance because every decision I make, I know if I'm putting it in equities or income, and I know what my amount in equities is and my amount in income because because I know what the cost basis is. It doesn't change with the market value every day. So
So where can
I look at
oh,
my equity total of cost basis, and it's right around anywhere between 40 and 30% is what my target is. If it's there, then I know if it's right there, then I know I pretty much don't need to add any more equities. I can add to the fixed income side. If it's a little lighter, then I have to add to the equity side. But as you get in income investing, it's not nearly as important as it is in growth-based investing because when you have a growth portfolio and you're doing all this stuff, you have to rebalance because you don't have much of an income portfolio, and you know you're just taking on more and more risk with no income involved. When you've got an income, when the equities are paying 9% and the income's paying 10%, there's not a whole lot of difference there.
yeah.
You know, yes, there's more risk in the equities than in the fixed income, but it's marginal instead of um, whatever the opposite of marginal is.
Uh, so where can we find your book?
Every
Retirement Money Secrets.
bookstores, you can find it. You can find it in those outlets that just sell ebooks. I think it's called Draft to Digital, something like that. We've got a audio version for those who like to listen instead of read. That's only available at Amazon.
That's
And
only
actually,
on Amazon is the
the audio,
audio version.
yeah, the audiobook is it. It was a whole different price configuration if you didn't let
Yeah.
them have the exclusive to it, and I didn't feel it was a problem. Um, Most of my sales are at Amazon anyway. I mean, I almost over around 5,600 at Amazon alone. So,
Oh, nice. So, Steve, wrap us up. You might have just give us a summary of your top three, four, five things that a good.
uh, I wrote down three things that I thought would help your audience,
All
and
right.
if they do these three things, they'll and they read the book, they'll they'll be able to put together a game plan, okay? Or they'll be able to talk to their advisor and say, "This is what I want." That's very important. Okay, first one, just to take a look at their statements and determine how much income they are generating. They'll probably find that it's 3% or less. And so that, and then they can start saying, I want to do something to improve on that. That's the idea. I know, I know from what I heard on the show that there are yields out there in excess of 3% that I can do. There are securities that pay much more than that. I want to get myself some of those. Okay. The second thing, again, look at your portfolio. And even though you love all the green color where they're up, look at the percentage of some of those profits and start taking your profits and diversifying your portfolio. That's the second one. And the third one is to start making the mindset switch from following and looking and focusing on the market value and then looking at that number first every time you get your statement or look online at your statement and start looking at the amount of income you're generating instead of the amount of market value. So with those three steps and assuming that they all the instructions we just gave them about quality and diversification and income, with that and this, then they should be fine to get themselves going.
I think that hard one is that market value, right? Because everybody, like you
I
said it just a
Oh, it
second ago.
is.
So I actually I trade in some crypto, but one of the guys that I follow, he when we do our charting, we take out all the color on the charts. There's absolutely no color. There's no prices, and it's just done by like little channel. It's pretty neat the way his system is set up, and it's all done like off of multiple indicators. Like he probably stacks 20 to 30 indicators on top of each other, in different ways, and they're all done. And the system is actually, I mean, this dude is, I'm not anywhere close to his category, but it does help getting rid of the color, right? Because that's like one of those things in our little brain. If you see green, you're all of a sudden you're excited. You see red, you're disappointed. And the same
See,
thing with your market value, right? If you see that plus, woo, like you're just automatically, you get all excited.
okay, well, let me just a little bit of caution
Yeah,
when you're dealing with numbers and you're looking at numbers and charts and all the other stuff is there's only it's only knowable up to that point. It's never ever a prediction
I
of what's going
agree.
to happen next. So decision making based on charts and numbers to me is just crazy.
No, I agree. And I have, I've moved, I just use a certain portion. Like I said, I have a gambling heart where I have to have a certain amount that I'm,
There's other ways you can gamble, Ernie. I mean,
I
you
know,
can,
man.
gamble with something that pays you income. I mean, you can do ETFs that contain business development corps, and they're paying 10 or 12% while you're hoping that something good happens. I mean, even if you're even you can even use crypto ETFs, which I have never gone anywhere near, but I know they're out there now, and some of them are paying ridiculous amounts of income, almost enough that if they don't go under for a year or two, you'll be fine. You know what I mean? So,
Yeah,
but
I have a couple.
but get diversified and get that income going.
I
That's
appreciate it, Steve. It was absolutely great talk, man. I learned a lot of stuff. I wish I'm not too old to change. I wish I would have heard from you 30 to 40, when I was 30 and 40, because I would have been a lot better off with some of the dumb shit that I did in life. But
well, you
because
can still straighten it out.
yep. No,
If,
and that's
if
the good point, right? We're
yeah,
never
yeah.
too old to at least
Oh,
get it
right.
straightened out.
Right. I mean, I've done it. I was fortunate. I was income focused right from the start, so it was really easy for me. And I see how difficult it is for others to make that transition. It's not an easy thing. When you get done with the book, I think you'll be in a better shape. You'll see the bigger picture better at that point, and we can talk again sometime.
I would love to, man. Thank you very much, Steve, for being on the show. And
Okay.
I think our guests or the guests are going to learn something from it. And go get the book and start doing some income investing because probably probably the right thing to do.
Yeah. Yeah. I think so, certainly. It takes the big mistakes out of the picture, and that's important. That's important.
Hugely.
Yeah.
Mm, bye.
Okay, man. Good talking to you.
Thank you. Bye.